When starting a business, one of the most important considerations for entrepreneurs is how to raise capital to fund their operations. Whether it's for research and development, hiring staff, or expanding into new markets, having access to funding can make or break a business. In this video, we'll explore the various ways that entrepreneurs can raise capital for their business, from traditional funding sources like loans and grants, to more unconventional methods like crowdfunding and angel investing. We'll discuss the pros and cons of each approach and provide tips on how to create a compelling pitch that will appeal to potential investors. Knowing how to raise capital is essential for any entrepreneur looking to start or grow a successful business. By the end of this video, you'll have a better understanding of the different funding options available to you, as well as the skills and knowledge needed to successfully pitch your business to potential investors. Understand your funding needs. Before starting the process of raising capital, it's essential to determine how much funding your business actually needs. Without a clear understanding of your funding needs, you may end up overestimating or underestimating the amount of capital required, which can lead to serious problems down the line. There are two broad categories of funding available: debt and equity. Debt funding refers to loans or other forms of borrowing, while equity funding involves selling a portion of the ownership of the company in exchange for investment. Let's take a closer look at the pros and cons of each funding type. Debt funding. 1. Pros. The lender has no ownership in the company, so you retain full control over your business. Interest payments on the loan can be tax deductible, generally less risky for the borrower than equity financing. 2. Cons. Interest payments must be made on time, even if the business isn't generating revenue. Defaulting on a loan can have serious consequences, including damage to your credit score and possible legal action by the lender. Equity funding. 1. Pros. No obligation to make regular payments, which can help with cash flow management. Investors can provide valuable expertise and connections in addition to funding. No obligation to repay the investment if the business fails. 2. Cons. Giving up partial ownership of the company can lead to conflicts over control and decision-making. Investors may demand a higher return on investment than you're comfortable with, which could put pressure on the business to grow quickly. Raising equity funding can be a time-consuming and challenging process, especially for startups without a proven track record. Ultimately, the choice between debt and equity funding depends on your specific business needs and goals. It's important to carefully consider the risks and benefits of each option before making a decision. Additionally, before approaching potential lenders or investors, it's essential to have a clear understanding of your funding needs and how you plan to use the capital raised. Develop a business plan. Having a solid business plan is essential for any entrepreneur seeking funding for their business. A business plan is a document that outlines the company's goals, strategies, and financial projections. It provides potential investors with a clear understanding of the business, its market, and its potential for growth. Here are some key components of a business plan. 1. Executive summary. This is a brief overview of the entire business plan, summarizing the key points and highlighting the most important aspects of the business. 2. Company description. This section provides a detailed description of the business, including its products or services, target market, and competitive landscape. 3. Market analysis. This section analyzes the industry and market in which the business operates, identifying key trends, opportunities, and threats. 4. Marketing strategy. This section outlines the company's marketing strategy, including its target audience, distribution channels, and promotional tactics. 5. Financial projections. This section includes detailed financial projections for the business, including revenue, expenses, and profit and loss statements. When creating a business plan that will appeal to investors, here are some tips to keep in mind. 1. Keep it concise and focused. Investors are busy people, and they don't want to read through a lengthy business plan that's filled with irrelevant information. 1. Keep your plan focused on the most important aspects of your business and make sure it's easy to read and understand. 2. Highlight your unique value proposition. Investors want to see that your business offers something unique and valuable to the market. 2. Make sure your business plan clearly outlines your unique value proposition and how you plan to differentiate yourself from the competition. 3. Use data to back up your claims. Investors want to see evidence that your business is viable and has potential for growth. 3. Use market research, financial projections, and other data to support your claims and provide evidence that your business is a good investment. 4. Be realistic with your financial projections. While investors want to see potential for growth, they also want to see that your financial projections are realistic and based on solid data. 4. Avoid making overly optimistic projections that aren't backed up by data. By creating a solid business plan that highlights the most important aspects of your business, you'll be better equipped to appeal to potential investors and secure the funding you need to grow your business. Identify potential sources of funding. Once you have a solid business plan in place, it's time to start looking for potential sources of funding. Here are some key things to keep in mind as you begin your search. 1. Types of investors. There are different types of investors, including 1. Angel investors. High net worth individuals who invest their own money into early stage companies in exchange for equity. 2. Venture capitalists. Professional investors who manage funds that invest in early stage companies with high growth potential. 3. Private equity investors. Investors who provide capital to companies in exchange for equity, typically in established businesses. 4. Crowdfunding platforms. Platforms that allow individuals to invest small amounts of money in exchange for equity in a business or a product. 1. Identify potential investors. To identify potential investors, start by researching investors who have previously invested in companies similar to yours. 1. You can also attend networking events and conferences to connect with potential investors in person. 1. Additionally, consider reaching out to business incubators or accelerators in your industry, as they may have connections to potential investors. 2. Pitching your business. When pitching your business to potential investors, it's important to focus on the key aspects that make your business unique and attractive to investors. 2. Here are some tips for creating a compelling pitch. 1. Start with a strong hook that captures the investor's attention. 2. Clearly explain the problem your business solves and how it's different from other solutions on the market. 3. Highlight your business's unique value proposition and its potential for growth. 4. Be prepared to answer questions and provide detailed information about your business, including financial projections and market research. 5. Practice your pitch so that you're confident and comfortable when presenting it to potential investors. By identifying potential investors and creating a compelling pitch that focuses on the most important aspects of your business, you'll be better equipped to secure the funding you need to take your business to the next level. Prepare your pitch. Preparing a pitch that will grab investors' attention and convince them to invest in your business is a critical step in the fundraising process. Here are some key elements of a successful pitch. 1. Clear value proposition. A clear and compelling value proposition is essential for any successful pitch. 1. You need to clearly communicate what problem your business solves, how it solves it, and why your solution is better than your competitors. 2. Compelling financial projections. Investors want to see that your business has the potential to generate significant returns on their investment. 2. Your financial projections should be realistic, based on sound data, and show potential for significant growth. 3. Experienced management team. Investors want to know that your business is being led by a capable and experienced management team. 3. Make sure to highlight the relevant experience of your team members and their track record of success. 4. Market opportunity. Investors want to see that there is a significant market opportunity for your business. 4. Make sure to provide a clear analysis of your target market, including size, growth potential, and any trends or opportunities that make it an attractive market. When preparing your pitch, here are some tips to keep in mind. 1. Keep it concise. Investors are busy people, and they don't have a lot of time to listen to long pitches. 1. Keep your pitch concise and focused on the most important aspects of your business. 2. Practice your delivery. Practice your pitch in front of friends, family, or colleagues to get feedback and improve your delivery. 2. You want to come across as confident, engaging, and knowledgeable. 3. Use visuals. Visual aids, such as slides or charts, can help to reinforce key points and make your pitch more engaging. 4. Anticipate questions. Investors will likely have questions about your business, so make sure to anticipate and prepare for those questions in advance. When preparing your pitch, there are also some common mistakes to avoid, such as 1. Being too vague. Your pitch should be specific and focused on the most important aspects of your business. 1. Avoid being too vague or general in your description of your business. 2. Overpromising. While you want to show potential for growth and success, it's important to be realistic in your projections. 2. Overpromising can lead to disappointment and loss of credibility. 3. Not knowing your audience. Different investors have different priorities and interests. 3. Make sure to research your audience and tailor your pitch to their specific interests and needs. By preparing a strong and compelling pitch that highlights the most important aspects of your business, and by avoiding common mistakes, you'll be better equipped to grab investors' attention and secure the funding you need to take your business to the next level. In summary, raising capital is a crucial step for any business looking to grow and expand. In this video, we discussed several key steps to successfully raise capital for your business, including 1. Understanding your funding needs and the different types of funding available. 2. Developing a solid business plan that communicates your vision and potential for growth. 3. Identifying potential sources of funding and pitching your business to investors. 4. Preparing a strong and compelling pitch that highlights the most important aspects of your business. Remember to tailor your pitch to your audience, be realistic in your financial projections, and anticipate and prepare for investors' questions. We encourage viewers to take action and start raising capital for their business. With the right strategy, preparation, and execution, you can secure the funding you need to take your business to the next level. For additional resources on raising capital, we recommend checking out the following. 1. Small Business Administration (SBA) website. 2. SCORE, Service Corps of Retired Executives website. 3. Local entrepreneur and investor networks. 4. Professional advisors, such as attorneys, accountants, and business consultants. Thank you for watching, and best of luck in raising capital for your business.